I'm Jim Cunningham. Welcome to Rethinking Portfolio Risk. I've got Shannon Beahan with me today to go over a very important topic, top of mind for a lot of clients. It's all about getting past the emotional investing and aligning your investments with your goals. So this is very important. This is a disclaimer. I'm a lawyer. Shannon is a certified financial planner. This is not legal advice or financial advice. Don't watch this and say, well, I saw Shannon say, and go out and do a bunch of stuff. Generally a bad idea. I'm the managing partner at CunninghamLegal, 25 years experience, offices throughout California, and I'm a certified specialist in estate planning, trust, and probate law. I also am a real estate broker, securities and insurance licensed, and a pilot, single engine, land instrument rated. These are the lawyers at our firm. We've got a great group of lawyers here to help our clients, and these are our office locations, and you can see there the Golden Gate Bridge and Southern California. So subscribe to our YouTube channel. If you're watching this on YouTube, you can go ahead and click the subscribe button below. And if you're watching this live, I'd really recommend you check out our YouTube page. Lots of great content on there. So Shannon, in preparing for this, one of the things, and I've lived through the dot-com thing, 08. There were some little hiccups in 2014 and 2017. And then obviously, COVID, we all kind of have lived through. But what I've seen is people really underestimate and don't think enough about the risk that they are taking to get a reward and the impact of emotions. And that's why we're doing this webinar, because you cannot ignore emotions. So with that, Shannon, take it away.
Yeah, Jim, I think you're spot on. I think we all inherently know that investing and risk goes hand in hand, that there isn't really, this opportunity for a reward without taking on some sort of risk. And the balance is the trick is really finding this balance between taking on the appropriate risk so that you can have the right amount of reward that aligns with your goals in particular. I think specifically in the last 10 years, we've gotten really fixated on looking at the return of, just one index, for example, just the S&P 500, and thinking that every investment account should have those kind of returns. And that's just not the case. We really need to balance that risk that we're taking versus what our goals actually are. And so I think that spending some time today talking about, okay, what is risk in investing? What are the different types? Because it's not just one type. What are some of the common ways that people add risk to their portfolios and their investment choices that they don't even know that they're doing? And behavioral factors is one of the biggest ones there. And then really taking some time to look at, okay, how do we really get our arms around this? How do we talk about risk? How do we measure risk? And what are some of the things that we can do to really mitigate it and sort of make it better? And I think that's really what the purpose of this webinar is today. What we're looking at here is just a list of some of the risks that people face in investing. This is not all encompassing, but these are some of the ones that I think come to mind most often. The first one is market risk, and this is essentially it's also called systematic risk. It's economic risk that something is going to happen and really put some downward pressure on the economy. It's the risk of a stock market crash. Basically, everything moves down together in an environment like that. This is the kind of risk that you really cannot avoid if you want to participate in that market. The only way to completely get market risk off the table is to take yourself out of the game. The only things right now that don't have market risk are things like CDs. And how much are you earning on a CD these days? The next two, interest rate and inflation risk, those are ones that, especially with the recent environment this week, we've talked a lot about these. As interest rates move, the Fed, has stated that they plan to move rates up 3 times next year. As rates move, that will change the value of investments. Bonds tend to struggle in that environment. Some tech stocks will struggle as well. And inflation risk, we are dealing with inflation that we haven't seen in decades, and making sure that we need to invest in such a way that we are getting returns to keep up with that inflation, right? So that's kind of the base hurdle. There's a lot of other ones on here, or a lot of other risks out there, whether that's political risk, liquidity risk, being able to get out of your investment when you need to. These are all things that we need to be mindful of, but I think the one that we are going to focus on today is really this behavioral risk, because this is something that's not talked about enough, I don't think. And it's the largest impact on an investor's returns and their outcomes by far. So if we advance actually to the next slide, we can kind of look at what are some of the common investor mistakes that people are making. And Jim, the way that you opened this in talking about, wanting to be involved in the S&P and really not understanding the risk that we're taking on, this first bullet point is why that is so important, is understanding what are your goals for investing, right? And I always like to say money in and of itself, or returns, high returns in and of themselves, is not a goal. Money is a tool. It allows us to do the things that we want to do, whether that's retire at a certain date, travel to certain places, put our kids, our grandkids through college, leave a legacy, philanthropic goals. That's the type of goals that we need to identify to make sure that we are investing in such a way that we're on the path to get there. And
well, obviously, as you're saying, I'm sorry to interrupt you. As you're saying this, I'm reminded by questions that I ask myself about money personally, is what is money for? Number one, and who is it for? And I think that's the context, because I would say the S&P 500, for example, or the Dow or whatever it is, are very attractive ways to think about investing, because it's very simple. It is a number that changes every day. You can say, what was that number 12 months ago? What was that number at the beginning of the year, the end of the year? But the problem is that lacks context for you, right? If you're watching this webinar or this video, what is this money for? Who is it for? I think you need to answer those questions and then build your portfolio around the answer to those questions, rather than just, I want to get S&P 500 returns. Anyway.
Exactly. Investing is so personal because it really needs to make sense for you as a person. That's why, in this disclosure, we get on here and I can't join a webinar and start making blanket recommendations about what's a good investment, because I don't know you. I don't know what's a good investment for you. And so that is kind of one of the biggest ways that we see people, quite frankly, shooting themselves in the foot, is just not being clear on where they want to go. Other behavioral mistakes that we see is attempting to time the market, buying and selling at the right times. That's just a recipe for disaster. You have to be right, not once, but twice, when to get out and when to get back in. And it's more, I'm sure you've heard the saying before, it's more about time in the market than timing the market. We just want you to be invested. And I think the hurdle for a lot of people getting invested is risk. What we see without fail, every time there's a pullback, we see a lot of people get scared, pull their money out of the accounts, liquidate everything, and sit on the sidelines because they say, hey, we lost 30%, I can't lose anymore. And then what happens is they stay on the sidelines. And so then when things inevitably begin to rebound and come back up, they're constantly looking for that entry point. Where's the right entry point? Oh, it's too high now. I need to wait for it to come back down again. And that leads to just staying on the sidelines and not participating in the market at all. So what we need to do is we need to find a way to get people invested and participating, but at the appropriate risk level, which we'll talk a little bit about that today. Chasing trends is another one that's come up a lot over the last year. There's been these names that are up 200, 300, 400%. I call it investing FOMO, fear of missing out. What people see is they see these names that have gone up. They hear their friends or their neighbors talking about something that they've made a ton of money on, and they say, oh, I want to get into that. And then they get into it at the high. So chasing trends can really be a problem. Too much turnover, not being patient with investments can cause tax issues, capital gains, and we start talking about wash sales. I mean, it's really complex when we start to think about all the decisions that need to be made around investing. Taking on inappropriate risk, obviously something that is aligned or goes hand in hand with knowing what your goals are. And when I say taking on inappropriate risk, I think a lot of times people tend to think, oh, I'm taking on too much risk. The flip side of that coin is you're not taking on enough risk. That's a risk in and of itself. Again, if you just sit on the sidelines, you're opening yourself up to that inflation risk that we talked about before. Your money's not keeping up with the pace of inflation. Your money doesn't go as far. Your portfolio is really declining in value, even if it's staying the same. And all that really boils down to is letting emotions rule investment decisions, whether that's exuberance and you get these things like FOMO and chasing trends, or whether that's fear and just sitting on the sidelines. So we need to look at this through a more objective, quantifiable lens so that we're able to make strategic decisions rather than emotions.
Yeah. And Shannon, you're raising a really interesting point. And I would say that one very common mistake I see with clients is they've worked hard, they've saved in the 401k or IRAs, they've saved in their portfolio. They may have worked at a company and gotten stock options and have investments. And they're many times they're with what I would call a wirehouse, which is the large institutions that are household names. And those institutions are, I believe their core function is to make America's capital market the best market in the world. I mean, that's really the core function. Yes, they do offer planning services in a sense, but that's really not their core mission, their core function. Absolutely. And you're a certified financial planner. And I will tell you, if you're watching this webinar, if you're watching this YouTube video, this is really a non-emotional math puzzle to work out. And really it's a certified financial planner who's the best person, the best, position, best role to accomplish that, to counsel you on what are your goals? What do you want to do? How long do you think you're going to live? These are all questions that you have. How much are you spending every year? What's your other income? And then what is this money for most people? It's for retirement. So they quit working. They don't want to outlive their money. And the question is, where do you invest that money? And then how much do you consume every year? So you perform a great service for people who are at that stage, frankly, that stage in their life.
Absolutely. And what we look at here is this is really kind of, again, quantifying what that impact is of those behavioral decisions that we're seeing investors make. This is a study put together by Dalbar, a company called Dalbar. And what it looked at was a 25-year period beginning 1995 going through the end of 2019. And it looked at the performance of an index and the performance of the average investor in that index. So what we see here is if you had invested $50,000 at the beginning of 1995 in the S&P 500 index, you would have received that dark blue return line. So by the end of those 25 years, your money has tenfold improved. That is if you would have just been in the index. What we actually see is that the average investor only experienced a growth to $326,000. And that's because of decisions around when to buy and when to sell. And we see that quantified over on the right-hand side of the screen. You would have received an annual return of over 10% in the index. The average investor received less than 8%. So you're losing more than 2% just based on the decisions that you're making. That disparity is even larger when we look at bonds, when we look at fixed income. The dark green bar represents the index, the light green bar represents the average investor. And I think what's really important to point out here is that this is just one study looking at average investors of S&P 500 only. But there's other factors that come in around making decisions about how much to be invested in equities and how much to be invested in bonds. I think this slide really hammers home the idea of being in the market and needing to find a way to be invested regardless of if you're scared. There's low risk investments that we can provide. Really interestingly, a data point that I actually just saw, Morningstar looked at a 20-year period inside of this period, and it encompassed about 5,200 trading days. And it looked at investors' experience within those 5,200 trading days. The average return over that period was 7%. If you would have missed the 10 best days, 10 out of 5,200, the return drops down to 3.5% annualized. It's half the return from 10 days. So it really matters. Being scared and sitting on the sidelines can really impact the long-term prospects of a plan. And so to your point about a CFP and why it's important to work with someone like that, we like to call ourselves advocate advisors, right? Because our job is to help clients make these tough decisions, is to help understand the overall picture and how we can implement investment decisions that you feel comfortable sticking to. So I put together a slide that just kind of shows some of the areas that we can help with. Jim, we've talked about this before in terms of that kind of financial planning hygiene. What are some of the things that we see? We spend a lot of our time reviewing clients' current portfolios, their current financial plans. And a lot of the times we see things that we shouldn't be seeing. So we've kind of put together just some red flags, quite honestly. Obviously, a financial planner, a certified financial planner can help you with investment strategy, whether that's identifying goals, how much can you afford to lose, quite frankly, based on your whole situation, both financially and psychologically. Some people just have a more appetite for risk. They can handle that roller coaster a little bit better, and we can help you determine where you fall on that. We can help make decisions around asset location. This is a red flag that we've seen before in the past is say an investment is appropriate for you, which one of your accounts does it go in? Should it go in your taxable account? Should it go in your IRA? And we really have seen some bad situations where we've seen IRAs, which are tax deferred accounts, so you're not paying any tax on the income that comes into those accounts anyway, filled with municipal bonds, which one of the major benefits of muni bonds is the special taxation of their interest. So there's gaps in what's going on in a lot of the statements that we are reviewing. And we need to be aware of some of those. And that's really where my team, myself and the other financial planners that work here, that's really where we focus our time, is helping clients see the things that they wouldn't otherwise see. Does that make sense?
Oh yeah. I mean, and as you were talking about this, I was thinking the classic example is municipal bonds and an IRA, because that interest on a municipal bond, you don't pay tax, state, federal, local tax, if it's in the state that you live in. If it's in your IRA, all that money, when it comes out of your IRA, unless it's a Roth, when that comes out, it's going to be taxable. And you could get a higher rate of return with a non-municipal bond that is taxable. And that would be an example of a strategy that you might want to consider if it was appropriate inside of your IRA, but not the tax-free, not the tax-free bond.
Yeah, exactly. And, another thing that we've already touched on a little bit is around retirement strategy. I think this is one of the major things that having a withdrawal strategy, there's a big difference between investing for accumulation, what most people have done their entire lives is stocking money away in their employer plan and just watching it grow. But when you flip that switch to distribution and you need to start figuring out, how do I replace my paycheck? Where is this money going to come from? That can get really tricky. And that's also, we'll take a look at a couple scenarios later where risk in the portfolio really comes into play with this withdrawal strategy. We can help with that. Adjusting portfolio risk for retirement. One of the things that always comes to mind when I think about risk in retirement is target date funds. And this is something that most people are familiar with if they have 401ks. And not to just, throw the baby out with the bathwater. They're not horrible investments, but they're not right for everyone. Essentially, what a target date does is you select an investment based on the year that you plan to retire. So essentially what happens is you end up invested with every other person that's your same age. And so to me, what that philosophy is saying is that every 65-year-old has the exact same financial situation, which we know that's not true. We don't know how much you have saved, what your expenses look like, what state you live in for that matter. Do you have a pension? Have you accumulated significant wealth in a real estate portfolio, for example? So really making sure that your investments are tailored to you and your situation is huge. Estate planning, this is an area, Jim, we look at these all the time together about kind of some of the red flags that we're seeing.
So here's biggest red flag is if somebody names their estate the beneficiary of their IRA, and that can happen if you can't find your beneficiary designation, which means not only does it go through probate, but it's all taxable in that year. Also, people do name their living trust. Now, I would say 99.9% of the time, naming your living trust is a wrong way to go. There are just very limited exceptions. And there's a long reason, lots of reasons why we use a different type of trust to handle IRAs. And we call that the IRA legacy trust. And then the proper estate administration. A lot of people drop the ball. We had a client a few years ago who their CPA did not check the right box, and it cost them a couple $1 million. So it's very important to have proper estate administration. This is where you have your A team, as we've said in prior webinars, your accountant, your financial advisor, and your attorney all working together when a person passes away. So estate administration means someone's passed away. And then, tax planning, I think, is one of the things that, again, if you go with a financial advisory firm, their number one charge is to make you money. And that is fine. But again, without context, what are the tax implications? And if you live in a state that has no state income tax, it's less of an issue. In California, we're paying tax pretty much double the federal rate in a lot of circumstances. So tax efficiency in investments and paying attention. One of the things that we offer in our firm is a family office, which is a variant of, I would say it's a subset of family offices. We're not paying your bills, but we're actively engaged in monitoring your investments, paying attention to taxes. And that we do have clients in that love it, and we save them. And actually, Shannon, we were in a meeting about a month ago in Las Vegas, and because the advisors met together, we were able to save our client about $300,000 in income tax that I believe, had we not been having that meeting, had we not had that meeting, because no advisor saw it on their own, we had to talk together. We never had that meeting, the client would have paid $300,000 more in taxes. Capital gains awareness. Remember, capital gains taxes, they say, oh, well, it's only 20% federal. Don't forget state capital gains taxes. And that's up to 13.3 plus 3.8% net investment income tax. So if you're a California resident, it can be as high as 37.1%, which is almost double the federal gains rate of 20. Why don't you talk about risk measures? So I hear these terms, alpha, beta. I think of the old supermarket alpha, beta. What if you can kind of walk us through us novices, so to speak, who might be watching this? What are these terms, and why should we pay attention to them?
You got it. I mean, we really can't handle risk and make adjustments to how much risk we have unless we can measure it, right? So these are the ways that we measure it. This is kind of the language of risk and investments. And I think people throw these terms around without really understanding exactly what they mean. In their most simple form, alpha essentially compares the risk of an investment, whether that's a portfolio of investments or a mutual fund, an ETF, a stock. It compares it to a benchmark index and says, is this particular investment doing better than its index or worse than its index? So a positive number is good, a negative number is bad. So you're just looking at a comparative number there. Beta is a really similar measure, except it looks at a risk measure as compared to a benchmark. So that would be volatility. What we mean by volatility is kind of when you look at a chart of a stock price, you see that it goes up and down. Does it go way up and way down, way up and way down? Or when you look at it across years, is it more of a rolling line, right? So that roller coaster up and down, that's going to be a more volatile investment. And so what beta does is it looks at the volatility of that investment as compared to its benchmark or similar investments. Does it move more or move less? So those are nice measures when we are trying to compare two things. But how do we quantify the volatility of an investment in a way that we can sort of compare it to itself? And standard deviation does that. So what standard deviation does is it looks at the volatility of a particular investment, and it compares that volatility to its own average return. So how normal is it essentially for a stock to have, or an investment to have, really high returns and really low returns? How much does it go up and down? And we can essentially use that as a measure of risk, as a standalone measure of risk. Where it really gets interesting and where we can really start using it as a tool is when we start using something called the Sharpe ratio. And what the Sharpe ratio does is it relates the return of an investment to its risk. So it looks at how much performance does an investment have per unit of standard deviation. So based on a standard unit of risk, how much return does that particular investment give you? So it allows us to see where's that balance between risk and reward. And that is what's called a risk adjusted return. So we can actually look at an example on the next page of kind of how Sharpe ratios are calculated and how to use them, how to think about them. So we've got two hypothetical portfolios here. And if we just looked at the return, the 1-year return, portfolio A has returned 14%. Portfolio B over that same time period has returned 11.5. If I just stopped talking there and said, which portfolio do you want to be in? Which one do you think most people would pick?
A.
Yeah. So then we need to start thinking about, okay, well, how did we get that return? A return metric on its own tells you very little about how it was achieved. Is it a result of investment skill? Is it a result of excessive risk? Was there a lot of leverage? Or is it just quite simply a result of a bull market? So we really need to understand how and why we got that return so that we can understand, is that a number or a portfolio that will be reliable and consistent over time? So in these two examples, portfolio A has a standard deviation of 10%, portfolio B standard deviation 7, which simply means that portfolio A is going up and down more than portfolio B is. It's a smoother ride for portfolio B. So then we calculate the Sharpe ratios, which is it essentially takes in the return and takes out what's called the risk-free rate of return. This is a hypothetical number at 1%. You probably can't get 1% in most places at a short-term risk-free rate of return, but hypothetically. And then we divide that return by the standard deviation. So portfolio A is giving you 1.3 return for every unit of standard deviation. Portfolio B is giving you 1.5 units of return for every unit of standard deviation. So for 1 unit of risk that you're taking on, portfolio B is actually giving you a better return. You're being rewarded more for the risk that you're taking in portfolio B than you are in portfolio A. And when we really start to think about, to your point, Jim, this is a mathematical equation. How would we increase the Sharpe ratio? The only way to do that is by increasing the return more than we're increasing the risk, or decreasing the risk less than we're decreasing the return. So this is really, it comes down to math here. And we need to make sure that at any given level of risk that we are choosing investments that give you the most return possible.
I've got a couple of questions here.
Sure.
So Anonymous asks, if the beneficiary of an IRA is a special needs trust, would that work like an IRA legacy trust? I would say the short answer, let me give you an example. In my example, no, because I don't know what that special needs trust has in it, right? I don't know what terms, but generally a special needs trust does not have the language that you do need to stretch out under the new rules under the Secure Act to stretch out the payments to the beneficiary with special needs over that beneficiary's lifetime. Because right now we have for people who are not chronically ill, disabled, you have to take all that money out after 10 years. If you're a special needs individual, an individual with special needs, that money can come out over that person's lifetime. That trust has to be written in a very special way. And so what we would do in our firm is we actually use the IRA Legacy Trust platform and then add to that the appropriate special needs trust language. Melissa asks, hello, the message I hear most often is that staying in the market is the most important action to do for one's portfolio. For a retiree in 2022 looking to withdraw, how to decide if and what to sell? Is it only to use funds for a certain purpose? Is it to change the investment, rebalancing? When is it good to sell a loser? Great questions.
Mm-hmm. And these are all questions that you would need to talk to an advisor about, right? Because it matters so much in your situation. So when we're looking at just, if we were talking only about IRA funds, in terms of when to sell, one of the things that we would always talk about outside of IRAs would be capital gains, for example, not something if you only have IRA money, which is why we talked about earlier, You might want to have some diversification in your tax characterization. You might want to have some Roth money as well. But it really depends on your situation, how your income structure, your income plan is structured, Social Security, pension, that sort of thing. So there's no real easy way to answer that question. It just really depends on the situation. It is important to stay invested in the market. As I, talked about, missing the 10 best days can have a huge impact. But you also want to make sure that you are invested in the right segments of the market, that you are taking on appropriate risk in the market, because being all invested, for example, in the S&P 500 is a lot different than being invested in a portfolio that's broadly diversified, that has an active allocation, which actually, if we look at the next slide, Jim, talks a lot about what are the kind of considerations that you need to take into account to make sure that you are making the right decisions about when to buy and when to sell. So I think proper diversification is one of the most important things when we talk about portfolio construction. And it's essentially the idea of not having all your eggs in one basket. And we see this as a common mistake when people are choosing their own investments, quite frankly, because what people tend to buy is the names that they hear quite often, or the names that they're familiar with. And so what that tends to be is large cap domestic stocks. And so essentially you're just loading your portfolio up with risk, and you don't have anything to ballast that. So a lot of the times, if a market event happened, all of those names that are similar are going to go down together. So we want a counterbalance. We want something in your portfolio that's going to go up when those things go down. And that in and of itself is a really hard task to complete on your own, because it's painful, Jim, because what that means is that you're going to look at your account and you're not going to see green across the board. Because if you did, essentially, we're not doing our job of diversification if everything in your account is behaving the same way. We need things that act differently. And so whether that's adding alternatives like real estate, commodities, precious metals, each of which have their own characteristics and right markets, or we'll talk about a strategy a little bit later that looks at options as well, but just having some sort of balance across the portfolio so that things are acting differently is really, really important. And that goes hand in hand with this idea of asset allocation. So asset allocation is the idea of, okay, how much in stocks do I need? How much in bonds? Within that stock portfolio, how much is domestic? How much is foreign? How much is large value? How much is small cap blend? So around making those strategic decisions about asset allocation, it allows us to adjust the risk in the portfolio based on what's happening in the market. Because of that, because that's what active management is for, it also requires constant monitoring. So Jim, back to that question we got about when to make those sales. It's a full-time job deciding when to make those investment decisions. And so, for example, here in our office at Ascent Wealth Management, we work very closely with an institutional money manager called Ladenburg Thalmann Asset Management. And what their team does is all day long, look at the markets, look at investments, and decide what to buy, what to sell. That's their number one focus. That's the only thing that they do. And what that allows them to do is really drill down on trends that they're seeing. And nobody has a crystal ball, and nobody saw COVID happening. But for example, at the end of 2019, Ladenburg thought that stocks were a little bit overvalued. They thought there was a little bit too much risk in the market. So they dialed it back. And I know it's hard now knowing what we know, but if you think back to 2019, there wasn't a lot of speculation about, a downturn in the near future. But Ladenburg was pretty confident that things were just getting a little frothy. And so they dialed back the risk. They took some of the equity exposure off the table, and that served our clients, their clients very well when we saw what happened in late February and into March of 2020. I think we all remember that. We probably wish we could forget it, but it's top of mind still for most of us. And then they also made that asset allocation decision very early on in April of 2020 to dial the risk back up, to put more of the asset allocation back to equities away from bonds back to equities so that they could really take advantage of the recovery, the very quick recovery that we had. So that's what we mean when we talk about tactical asset allocation, is being on top of it and making those buy and sell decisions. One thing that I do want to make sure that we talk about for sure, Jim, is this idea around active versus index investing, because especially over the last 10 years or so, it's been pretty easy to look smart by index investing. And while there's certainly strengths to index investing, it's simple, it tends to be pretty tax efficient, generally low cost. Cheaper isn't always better. It's one factor, but it's not the only one. When you are doing index investing, you really lose a lot of the control over your asset allocation. So actually, Jim and I just recently were talking about how, let's say you bought an S&P 500 ETF. That means that you own all 500 companies that are in the S&P 500. And just recently, I read a statistic that since April of this year, 51% of the S&P 500 return is attributable to 5 companies. So why do you want to own the other 495? You know, I mean, I don't think anybody could have predicted which 5 companies it was, but to be able to be strategic about that, you lose that ability when you're index investing. Another thing I think is really interesting with index investing that often doesn't get talked about is this idea of when something is added to an index, you automatically have to buy it because it becomes part of the index. And what we see happen over and over and over is that when it's announced that something will be added to an index, we saw this happen recently with Tesla. When it's announced that something's going to be added to an index, the price of that investment gets driven up. And then when what reconstitution, it's called, happens, and it gets added into the index that you're invested in, you are now buying it at this increased price. So you're essentially forced to buy high. So while there are good things about index investing, it also definitely has its limits. And there are certainly places where we want to have active management. And what active management means is simply that let's take, for example, a peer of the S&P 500. An ETF that is indexing is going to own all 500 companies. A mutual fund that might benchmark itself to the S&P 500 is able to choose which companies it wants to own. And it might not have to be only S&P 500 companies as well. They might be able to go outside of that index where they see good opportunities. This is especially important in areas of the market that are less efficient. So this would be areas like frontier markets, emerging markets, high yield credit. These are areas where a human expertise really matters. It can really make the difference. You don't want to own everything. So definitely each has its place, but we want to be cognizant of the risks that we're taking on based on the investment strategy that we're utilizing.
Yeah, and I'm looking here at these numbers up and down. Something to remember, just this is a basic concept, is if you have a portfolio worth $100,000 and it goes down 20%, it goes down to $80,000. When it goes back up 20%, it goes to 96,000. You're 4,000 short. So if you try and add up the pluses and minuses, it does not equal zero. And this is their relative numbers. So it says the S&P 500 closed December 31 of every year. And if you look at the positives and negatives, you really have to have some mindfulness to figure out, you know, what really is going on, because those are relative to what happened the prior year.
And that volatility management on the downside is especially important for people that are nearing retirement and entering retirement. To the question earlier about, hey, what if you're going to retire in 2022? It is even more important that we have risk management and an income strategy in place for you. For those of you who are regulars on the Cunningham webinars, you might recall these slides from our discussion around having an income strategy. But this idea of sequence of returns is really important. This is also called sequence risk. And what it looks at, or what it's kind of pointing out, is that there is a real danger or a real risk to a portfolio's longevity based on the return in those first few years of retirement. So in this scenario that we're looking at here, David, he retires at the end of 1994. He's got $2,500 or $250,000 invested. And he's really lucky. Those first several years of his retirement are absolutely wonderful. And so he is able to take 5% out a year. And after just a few years of retirement, down in 1998, he's already doubled his money and he's been living off of it as well. And so what that shows us is that 20 years into retirement, he's got $1 million still in his account and he's been drawing on it. He got really lucky. The flip side of that coin is Monica. And Monica, unfortunately, retired right as the dot-com bubble was bursting. And so same amount of money invested, but her first several years of retirement were negative. And so we fast forward all the way 20 years down to 2019. That leaves her with $95,000. And you'll remember David's situation, he had $1 million at this point in his retirement. And what this is really pointing out is how important it is to have a strategy around withdrawals. You are you're stressing your portfolio if you are withdrawing in a negative market environment. So this is why income diversification is so important, and having other strategies or other accounts, other places to draw on. This is also a really good example of why we wouldn't want to be fully invested in the S&P 500 as we were entering retirement as well.
Yeah, I think, isn't the technical term for that eating your seed corn? Like eating that, like these investments that are designed to grow, a lot of people will have a chunk invested and then a chunk in cash for living expenses, for whatever it is they need. Because remember, this is not happening in isolation. You've got Social Security, you might have a pension benefit, you might have annuity payments from something, you might have deferred comp, you might have a lot of other things going on. And it's really important to pay attention to all the factors that are going on and then deploy your capital appropriately. I will tell you, I do not believe fundamentally this is a do-it-yourself project. I think even if you're a financial planner, you probably should be hiring a financial planner to help you. It's like Abraham Lincoln said, if you represent yourself, you have a fool for a client. I would say the same applies broadly to investing. And I think a lot of people, they say, I got this. I don't really, it's just invested. I'm not paying attention to it. But when that day comes, look at these drawdowns, 22% in 2002. I remember that. I was there. 2008. I remember talking to a financial advisor who was a friend of mine, and he called me in a panic. This was the very bottom of the market in 2008. It was like 6,700 Dow or something. He said, my client wants to liquidate everything and put it into cash. I think this is the absolute wrong thing to do. And I said, you have to do what your client tells you to do. And unfortunately, that person missed out on one of those 5 days, right? Because those big days, those big recovery days typically follow a sharp drawdown, don't they? They're not just random, like it goes up 8%. They're following some big drawdown.
Well, absolutely. And I think what also happens is that hindsight can sometimes tend to make things look a little rosier than they are. I think volatility is a lot more normal than most people remember it to be. So when we look or think historically about returns, and we can actually see it on the next chart, we think about annual returns, and a lot of them are positive. But what people forget is that during that year that was positive, there was often a pullback. So what this illustrates is each one of these bars represents a year and the S&P 500's return for that year. So the easiest one to point out here is that large one on the way down, that's 2008. We all remember that one. So that's where the year ended. And you can see most of them are positive. 75% of them are positive. But what we are forgetting is the red dots. And what the red dot represents is the pullback during the year. So even though in a horrible year like 2008, the market finished down 38%, at one point it was down 49%. It was down 50%. And it rebounded. And look at how many years there are, especially like in the late 90s and the early 2000s after the dot-com bust, where there was a significant pullback during the year, but we still had positive returns. And I think people forget that. There's a lot of volatility, especially these days, and has always been this way, that's caused by headlines. It's an emotional response. The market's emotional, just like humans. We saw it this week, early Monday and Tuesday. There was a lot of kind of just uncertainty in the market about what was going to happen in this Fed meeting. And the market was complaining. And then what we saw Wednesday after the Fed came out and sort of let us know for certain what their plan was going to be on rolling back some of this tapering, the interest rate rises for next year, it was almost like the market kind of breathed a sigh of relief, like, oh, okay, now we know what's happening. And we look at today, even we've got mixed markets. So it's very, it's normal for markets to go up and down, and we're never going to be able to get rid of this. But what we need to be able to do is be strategic about how much we are exposing our portfolios to this volatility, and be very smart about being strategic in nature about where we're invested. So how do we do that, right? How do we actually see the future, if you will? I wish I had a crystal ball. My job would be a lot easier. But
well, hey, that's your business. You're in the business of predicting the future, right? Really, I mean, that you're a futurist.
We have to be. And one of the things, there's a lot of different ways that we can we always look at what happened historically and try to extrapolate that into the future, but that's not always what will happen. But there's things that we can look at that give us an idea of where we're heading. And so the leading economic index is one of those tools. And what it does is it looks at 10 different components from different sources and creates kind of a composite number for us. It looks at things like orders, the labor market, unemployment, so we can see how healthy our business is, how healthy are consumers, how much are they going to spend. It looks at permits for building. Interestingly, I always like to point out that the stock prices are on here as a leading economic indicator. And I think a lot of people don't think about it that way. But again, what happened this week? The market went down on Monday and Tuesday, kind of pricing in an expectation of rate hikes for next year. And then when we found out there were going to be, we kind of settled a little bit. And so when we take all of these indicators and put them together into a number, the number itself really doesn't mean that much, but what does matter is how that number is changing. So we always like to look at, okay, here's where we are today. Where were we a year ago? How much have we changed in that year? So what this graph is looking at is the average distance to a recession based on the year over year change in this index. So as of the last reading came out in October, and as of October's reading, we were at 9.3% year over year change. So we were well within those green numbers over there on the right. And what this tells us is that we are predicting somewhere, the index is predicting somewhere in the range of 50 to 60 months before a recession. So based on this indicator, we are 5 years away from another recession. And we feel pretty good about that. And that gives us a good indication of where things are going. And we can even get really granular with this tool. And we're able to look at, based on where the index is today, how have different asset classes performed? How have large cap stocks performed? How have small cap equities performed? And we're able to use this as a tool to gauge, based on the current prediction for the economic environment in the future, in the short term, where should we be invested to get you the best risk-adjusted returns, which is really what it comes down to. And so, Jim, let's pause here. Are there any outstanding questions that we should address?
Not at this time, but if you have any questions, go ahead and put them in the Q&A. I think we're getting close to getting through this.
Awesome. So these last couple of slides that we have here are just essentially examples of this idea of risk management in action. So you remember when I talked about diversification being really important and finding investments that behave differently than equities, for example. This is some data on one of the mutual funds that we use in our portfolios, and we really like the way that it behaves. Essentially what it is an equity investment with an options overlay strategy that hedges 100% of the portfolio 100% of the time. So that portfolio manager is not making decisions on how much risk they think is in the market at that time. They're always protecting the investment. It's called the JP Morgan Hedged Equity Strategy. And what I think is really interesting is looking at how this investment performs as compared to the market at large, or the S&P 500. So this first set of numbers here is what happened in March of 2020, which March of 2020 is it's well after the decline had started, and actually the rebound began at the end of March. So it doesn't show the whole picture of what we experienced for the kind of COVID panic, but I think we all remember it was bad. And the S&P 500 just for the month of March was down more than 12% in that 1 month. Meanwhile, this JP Morgan hedged equity strategy was only down 1.5%. So essentially what we're doing is we're protecting you from that downside. And again, remember those numbers. If we can save you on the downside, you don't need as much return on the upside to get to the same place. The same was true for this particular fund back in December of 2018. That's a little bit further removed, but remember we had that issue with China and the tariff there and trade issues. Same thing there. Market was down 9%. This fund down 2%. Really saved on the downside. But what's important here is that we are also protecting on, or also participating in the upside. When we look at the rolling returns through up and down periods over 3 and 5 years, we can see that we're getting a lot of the upside of the market, right? So for over the last 3 years, the S&P 500's done 21.5%. This fund's done almost 13%. So investors in this have been saved more than 10% on the downside. And again, remember that that's 11% you don't have to make up on the upside, and they're still participating. So essentially, we're just putting guardrails on the equity investment. We are narrowing the range of possible returns. This is exactly what we're talking about when we're talking about a way to get invested at an appropriate risk level.
Yeah, and if any of you have margined your portfolio, really pay attention to this, because a lot of people are buying real estate. This is not on retirement accounts, but if you just have a portfolio of $1 million and you borrow 500,000 on it to buy a piece of investment real estate, if your equities drop to 900, you're going to have a margin call. You have to come up with cash, which means you have to sell stock to pay down, and it's kind of in a downward spiral. We've got some questions here. Anonymous asks, if we expect a recession in 5 years, which I want to briefly discuss that. If we expect a recession in 5 years and the first 3 years of retirement are the most important, it sounds like it's much better to retire now than wait 4 years. Is that right? Well, Anonymous, and I'll let you talk, Shannon, about that. But what I've heard, what Shannon was saying is we're not expecting a recession in 5 years, but it's 5 years or later. What I'm seeing in the demographics is the millennials who are buying houses faster than people thought they would. Yes, they're actually leaving the cities and they're buying homes with yards in suburbs that they swore they'd never go back to, where they grew up. Millennials are buying houses. Millennials will hit their peak spending in the year 2029. What that means is consumers will be spending less after 2029. So we're in the very end of 2021, that's 8 years. So a lot of smart kids, a lot of economists are saying, expect real economic problems in the 2030s, like we had in the 1930s. But from here to the end of the 2020s, on a macro level, we're not expecting a problem because of that demographic push to spend. I don't know if you have any thoughts on that, Shannon.
No, I totally agree. And I think looking at it strategically from a portfolio management point of view, I would say, obviously, their situation is individual to them. So you'd want to talk to a financial advisor about it. We'd be happy to review it with you. But it might not be that you want to retire now, but maybe you make sure that a portion of your investments is available to you that is less risky, that's not exposed to this volatility, so that you can use those assets to draw on should the first several years of your retirement be down years. Essentially, what we're trying to avoid is you having to sell out of your investments in order to fund your lifestyle during negative markets. So if we can have other investments that are not down as much, that we've set aside specifically to cover expenses, as long as your portfolio allows that you've got enough saved, we never want you to, make a retirement decision based on an economic prediction. We want to adjust your plan.
Yeah. And something not to forget is, I would say, the pleasure, the good feelings of making a lot of money are way outweighed by the bad feelings of losing a lot of money. So we have a saying in flying, and I'm a 3rd generation pilot. I'm the only one in my family who hasn't crashed a plane. Everyone lived. And so there we have a saying: I'd rather be down here wishing I was up there than up there wishing I was down here. I'd rather be in a position where it's like, gosh darn it, I only got 15% of my return. It didn't meet the S&P 500 index at 25, then, oh my gosh, I just lost 25% of my portfolio. So that's me. I'm speaking personally. I think most people share that view. Anonymous asks, can rolling 401k funds into an annuity or any other strategy help reduce required minimum distributions each year? I think sadly the answer is no. Your minimum distributions are based on the total account value on the December 31 of a given year. And it's the following year where you, under normal circumstances, would have to take out a minimum distribution by the following December 31. So I'm sorry, Anonymous, if it were that easy, everyone would do it.
The only thing that I would add there is that what we could look at doing while we're still allowed to within the laws is a Roth conversion. There are strategies that we can take to reduce the balance of your IRA before you start taking RMDs, before you hit that age 72, that can reduce RMDs. So that's one thing to consider.
Yeah. And remember, I think it was before 2011, you could not do a Roth conversion if you made more than $100,000 a year. Well, there's no income cap on that. So that's why they call it a backdoor Roth conversion. So if you've got a $10 million IRA, when you hit 72, your minimum distributions are going to be almost $400,000. That's a big number, right? That's a number that's just going to be added to your income. It's going to go from the left pocket to the right pocket, and you're going to pay a bunch of tax. And Richard asks, how do you factor in the CDC's onerous prediction for the continuation of COVID to your prediction of the next recession being 5 years out? So I think we answered the 5-year recession. I know in one of our previous webinars, I asked Phil Blancato with Ladenburg Thalmann, how long is COVID going to last? What are the smart people saying on Wall Street? And his prediction, kind of the consensus, is November of 2023, which is about 2 years from now, which means we're not even halfway through COVID. That's when the world will be vaccinated. But I am sad to say, I think, Shannon, you would agree with me, COVID is going to be with humanity forever. It's not going away. So it's just it's like Spanish influenza. It's never going away. Mm-hmm. All right. On that happy note.
Well, on that, this is actually a happy note. I'm glad that we're going to end on this slide, because this is what we spend a lot of our time doing with clients is we oftentimes, I already mentioned, we review people's situations and help them understand where they are at. And one of the things that involves is looking at investments and doing an analysis of current investments. And so oftentimes what we're able to do for clients or prospective clients is we're able to look at where their investments are now and compare them to sort of a recommended strategy. And so this is just a portion of a report that we created for an actual client, which we've blacked their name out, obviously. But let's look at the 5-year numbers, just so that we're all looking at the same numbers. And essentially what this is showing is the very first line that says existing client. That's how that client was invested when they came to us, their existing statements from their current firm. It was a wirehouse firm. And the next line is a mutual fund portfolio that is a growth risk tolerance that's managed by Ladenburg Thalmann Asset Management that I mentioned earlier. And then the following 2 lines are benchmarks. So the S&P 500 and a fixed income benchmark. So we'll go column by column and just kind of touch on what these numbers are telling us. Return, obviously, we all know what return is. In this particular case, what we're showing is that over 5 years, our recommended portfolio would have performed slightly less than the client's current portfolio per year over those 5 years. The next column, standard deviation, you'll remember this is our measure of volatility. And so what you'll see here is our proposed portfolio is significantly less in standard deviation than the client's current portfolio is at 15. So we are significantly lowering the standard deviation and only marginally lowering the return. And remember when we talked about Sharpe ratio, what does that do to the Sharpe ratio? It increases the Sharpe ratio. So for every unit of volatility that this client has in their portfolio, currently they're getting 0.94 units of return. Our suggested portfolio, they're getting 1.13 units of return for every risk unit that they're taking. So they are taking on less risk and getting more return, which is the whole point of what we're trying to convey within what a risk-adjusted return is. We really want to make sure that we are being cognizant of how are we getting the returns that we are getting? What risk are we taking on in order to get that return?
What's the Sortino ratio? That's not pasta, is it?
I wish it was.
Right.
So the Sortino ratio is very similar to the Sharpe ratio. The difference here is that it only penalizes for volatility on the downside, right? Because the Sortino ratio is saying, hey, if there's volatility on the upside, if it goes higher than you thought it was going to go, that's a good thing. So the Sortino ratio is just a little bit more complex formula that only looks at downside volatility. And same as Sharpe ratio here, higher is better.
Good. Higher is better. That's good to know. I mean, because all these, this is a lot of this pretty dense stuff, but the higher the ratio, the better. That's a good thing. Anonymous asks, for millennials, would you recommend Roth IRA or 401k, and why?
It totally depends on someone's situation. I think for a millennial that's just getting started, the important thing is save, 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 save. What we're considering when we're thinking about, do we want to make Roth contributions or tax deferred contributions, is how much in taxes are you paying now, and how much do you think you'll pay in taxes in the future? If you are in a lower tax bracket now than you think you will be in the future, Roth contribution. If you're in a higher tax bracket now than you think you will be in the future, make that tax deferred contribution so you don't have to pay tax on that income. It's not quite that simple. Like we talked about earlier, we want to have diversification between different types, but that's just one consideration.
Also, if you itemize your deductions or not, that plays into it. And I think that's a really important conversation to have with the financial advisor, with the financial planner, because, you know, there's an axiom that I think it was, I don't know if it was Warren Buffett said it, get rich slow, don't get rich quick. And part of this is, it is not an event. It's not, I'm going to put some money in the market and get rich next week. This is a habit. And I know with my own son, he's maxing out his 401k at work, and they have a very generous match. And if you're not taking advantage of the match, you know, if you're currently employed as a W-2 and your employer provides a match, it really makes economic sense to put at least enough in there to get a match, because it's a free, I mean, it's a free pay raise. Why wouldn't you do that? And people say, well, I need the money for this, or I need the money for that. Well, my answer is figure it out, because why would you let another 4% or 8% or whatever the match is of your comp? Why would you let that go away? So here's our contact information. You can reach us on our respective websites, or you can call us on the phone. And remember, subscribe. If you're watching this on YouTube, you can hit the subscribe button. And we really enjoy doing these. We do them every week. Today's a Thursday. We typically do these on Thursday at noon. Pacific time. But if you have any other questions, we've come to the end of our time here together. If you have any last questions, Shannon, I want to thank you. As always, it's been a pleasure to go over this very important information with clients. And I know I've been on the phone where literally people are crying. They're like, I'm panicked. You know, it's just blood in the streets in terms of like, markets are down. Markets are closed. Remember 9/11, they closed. And, you know, there's a lot of panic. And I've just seen a lot of people, frankly, make emotional decisions that are really not aligned with their long-term goals. And so you let the emotions get clouded. And that's really, I'm sure in those days as a financial advisor, you feel more like a psychotherapist than anything else.
That's a big part of the job, man.
All right. Well, on that happy note, have a great day. Remember, subscribe to our YouTube page, and we will see you next time.